Hello everyone, and thank you for attending today's webinar, H2O Investing, Combining the Best Elements Within Smart Beta. I'm Drew Boros, Editor-in-Chief of ETF.com, and I'll be your moderator for today's webinar. Before we get started, we want to cover a few housekeeping items. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer these during the webcast, but if a fuller answer is needed, or we run out of time, it will be answered later via email. We do capture all questions. You can expand your slide area by clicking on the maximize icon on the top right of the slide area, or by dragging the bottom right corner of the slide area. If you have any technical difficulty, please click on the help widget. It has a question mark icon and covers common technical issues. An on-demand version of the webcast will be available approximately 1 day after the webcast and can be accessed using the same audience link that was sent to you earlier. So on to our webinar, H2O Investing, Combining the Best Elements Within Smart Beta. Why the H2 analogy? Well, both hydrogen and oxygen are famously combustible in many scenarios, but when combined appropriately, they create the most important compound for sustaining life as we know it. Today, Dave Gideon, Vice President of NASDAQ, and Jay Gragnani, Vice President of Dorsey, Wright Associates, will explain how combining some of the powerful return factors now available within the ETF space become even more useful when combined with the right complementary elements in the ETF world. And with that, I will hand it over to Dave Gideon, Vice President of NASDAQ.
Good morning and good afternoon, everyone, and thank you very much for that great introduction, Drew. It is a distinct honor to be speaking to everyone today with my new colleague from Dorsey, Wright Associates, Jay Gragnani, or as many of you may know him already as JG. This is a great opportunity for us to bring out some education from the NASDAQ Dorsey Wright side of things and really talk a little bit about Smart Beta from a simplistic viewpoint of really what it is, how we view it, and then turn it over to Jay to see some the great aspects of Smart Beta in action. Just to give a quick overview on NASDAQ, obviously we have a robust index business that's been growing since we first became an exchange in 1971. As you can see, a series of great mile markers of our growth, whether it's the launch of the Qs in 1999, our green economy family in 2010, the dividend and income family in the acquisition of the Emergent index business in partnership with BoltShares, or obviously, as we just did at the start of this year, the acquisition of Dorsey Wright. And so now to take a little bit and to pause on Dorsey Wright specifically, so we announced the acquisition on January 5th, 2015. We were bringing the DWA indexes that many of you know and love under the NASDAQ umbrella as it significantly expands NASDAQ's Smart Beta offering and very much focuses that in and around perhaps one of the most effective factors in all of Smart Beta and really in all of investing, the momentum factor. We've become now the single largest provider of momentum-based indexes, and one of the great things we saw about this was how DWA was an early adopter, not just in and around the single factor, but able to take that factor and apply it across the broad spectrum of investing, whether it's in sector selection, broad asset selection, and really becoming a leader or a true pioneer of the tactical asset allocation models. Quick background on Dorsey Wright, but I'll have Jay when he kicks off to go into far more detail about Dorsey Wright. Founded in 1987, a web platform utilized by thousands upon thousands of advisors providing technical analysis. Launched their first index in 2007 at the basis of an ETF. It was focused on momentum via its proprietary relative strength methodology. It has done very, very well, and that business has expanded now into new markets, into new types of Smart Beta, focusing in and around tactical asset allocation and other ways of representing the momentum factor. So now to turn more broadly to Smart Beta. So how does NASDAQ view it? How do we see what this great topic is, as many, many people have taken a keen eye to Smart Beta? So at its core, and it's an alternative approach to the existing benchmark, or an application of a particular market segment. We like to think of the main verbs here. You're screening, you're filtering, you're tilting, you're overweighting, you're underweighting. You're essentially altering the risk-return profile of a benchmark via systematic rule. And one of the things that I'm a very big proponent of with smart beta is that everything we do and everything we create is repeatable and replicable. Time after time, market after market, no matter the condition, no matter what happens to rates, no matter what happens to earnings or valuations, the strategy that is being implemented under the smart beta is repeated and it's replicable. So it's tradable, it can be implemented into the market, and we will constantly be repeating that based on, very important here, rules-based, transparent processes. So we're taking those rules-based and transparent processes to overweight or underweight or even tilt to certain factors or fundamental metrics. NASDAQ as a whole are extreme believers in smart beta, and as it brings about an increased opportunity for an altered approach to create investment results which better align with the particular investor's needs. What has driven this shift has been the technological advancements in and around investing, data, researching, really the pure computer power, and probably is very helped that we've had for the last 15 years, a very interesting market which has brought about needs for this to move beyond just a core benchmark and moved into a smarter benchmark. We like to focus in and around finding new opportunities to exploit those investment factors, whether it's a unique factor such as momentum or dividends or buybacks, or try and bundle everything together along with some fundamental metrics and create something unique and create and drive alpha opportunities through objective and rules-based indexes. And as our colleagues and industry compatriots have spoken to you guys already this week, why is smart beta so popular now? The easiest answer to me is it's a driving force of investment lexicon. It's not just rooted in great returns or this great equity bull market we've had, but it helps tell a better story of why invest and where to invest. Active managers were the original smart beta investors. They developed strategies to take advantage of certain factors or fundamentals within the market, whether it's a deep value guy, the dividend guy, the momentum guy, or the guy who combined everything together. That's what active did. They were the first here in the smart beta side, but they lost out. Technology has removed that information advantage for those active managers. And then on top of that, the relentless drive of efficiency or lower fees has led to that need of rules-based and transparent approaches to really target those same principles, but do it more efficiently, do it for less cost, and really do it better. Today, anyone with FactSet, or Quandl, or Yahoo Finance, or any source of market data, and be able to take that and create a sophisticated investment strategy and drive that into the marketplace. We've seen it time and again of shops coming up and seeing a gap in the marketplace, being able to innovate and create and drive success off of that. Now, one of the things that I think is very important to talk about is, what is smart beta not? What does it lack? Well, it's not a silver bullet. It's not I bought a smart beta fund or I track a smart beta index and everything's going to be great all the time. It's not all weather to that effect. If you're focusing in around particular factors can fall out of favor by no fault of their own. A low volatility in factor in 2013 didn't work out that well compared to the broad-based benchmark. The low volatility factor in 2009 did a great job. 2002 did a great job. So you have to be aware of the factors or fundamentals that you're focusing on can fall in and out of favor. They're not all the weather. And as much as we love talking about smart beta, it really isn't perfect. Flaws can exist. You will not always outperform. The most creative strategy that can be created at some point will lag its benchmark. The key though is to make sure that we are creating these rules and these factors so that if we do fall out of favor, if we do underperform against our benchmark, we're doing so because we know why we're doing so, because of the rules and the transparency that we create, which is one of the key differences when you look at smart beta versus active. And so this is a slide that I always like to put up when we're out talking about why we like smart beta or why we like this technology side. So here's a balanced fund that the team here at NASDAQ created a 50-50 blend of equity and fixed income with a couple strategies that it utilizes, and then a trend following process to be able to allocate its full weights between equity and fixed income. And we compare it against one of the largest balanced funds in the world by our friends at American Funds. And you see monumental outperformance over the trailing 10-year period. And here's something that was created, a Boolean effects that were able to generate this data, bring in the concept, test the concept, and continuously improve upon it. And now be able to look back and see a great strategy that gets created really from scratch. And just to continue then on the strategy side of smart beta, the thing that we want to focus on is what's the most basic. The most basic to us is market cap versus equal weight. Everyone's very familiar with this. Market cap weighted largest companies with the largest market capitalization, equal weighting, exact same components assigned an equal weight throughout, no matter their size, no matter their revenue, no matter their valuation. Equal weight's great. It's very easy to understand. It creates a better opportunity for diversification. You have broader exposure to various companies from a performance perspective, all the while maintaining a very, very similar risk-return profile as your market cap component. Now, of course, equal weighting could be a double-edged sword. Equal weight reduces overexposure to mega caps, but if those mega caps are outperforming, you're now going to be trailing your broad market. And you can also then run into the problem of the cap-weighted index often leads it towards a growth style. Because equal weight sells winners and buys laggards, it exhibits far more of a value tilt, and also exhibits far more of a smaller cap tilt in general. So here we take a quick look at the NASDAQ 100 market cap versus the NASDAQ 100 equal weight. Very similar performance, very similar volatility, very similar, in fact, sector allocation. An index that works its way through very similarly overall. And in this case, we actually see outperformance of the market cap weighted index over the last year, over the last 5 years, but in fact not over the last 3 years. So you can see, depending on what is going on in the market, really with the mega caps of the names, that's 100, that's Apple, Google, Microsoft, Cisco, Intel, et cetera, you can see differences in performance. Now, when we look at that of the S&P 500, though, we see a different story. We see far more outperformance on the equal weight side than we do on the market cap weighted side. Sector exposures start to become a little bit more even on the S&P 500 equal weight versus the S&P 500 market cap weight. Volatility, though, kicks in a little bit higher. And so from a risk-return profile, you perhaps, your Sharpe or your information ratios perhaps are in line, but your overall total return is definitely enhanced. And so then we look into what does equal weighting do from a metric perspective. What does it do to your price to book, or your price to cash flow, your price to earnings, some of those, your yield, some of those factors that you really like to dig into. And what's interesting is you don't see much of a difference. You see that equal weighting in a way of generating smarter beta also generates that beta in and of itself. Where you see the big difference between both for the NASDAQ 100 and the S&P 500 is an increase in the PE, increase in valuation. Now, there are two aspects of that. There's obviously an increased valuation could mean a higher price, which you would see here with S&P, where the S&P 500 equal weight has been outperforming the market cap weight. But it can also mean that you're tilting more towards names with lower or no earnings if you're focused in and around that PE metric alone. But from a price to book perspective, near identical. The price to cash flow perspective, near identical. And the yield also very, very closely in line. So those core metrics, you are generating items that are very, very close in kind of what you want to see. So now let's turn into, I think, a more advanced smart beta factor in momentum. And momentum is an identified factor. Fama French has many AQR. There's been research for 40, 50 years now on momentum as an identified factor that has generated a stronger return profile than other factors. Over the long run, momentum outperforms value, outperforms size, outperforms volatility, et cetera. And the factor that's very interesting about momentum is that it's based primarily on price change. It's not rooted in valuation. It's not rooted in cash flow. It's not rooted in size. It is purely a price-based side. And momentum can be accessed via very different approaches, whether it's pure price change, relative price change, point and figure charting, volatility adjusted price changing, volatility adjusted price changing over a short plus long period. There are many different ways of defining and accessing momentum, and that can produce different performance results based on that same factor, which is very important. And as we prepare to turn this over to Jay to talk about combining the return factors, is to see how the Dorsey-Wright methodology in and around momentum really works, and especially when you start to combine that in and around some other factors. So without further ado, I'd really love to turn it over to Jay Gragnani of Dorsey, Wright Associates.
That's great, Dave. Thank you very much, and it's an honor and a privilege to be here talking with everybody, as well as Dave, as you said, as new colleagues. Great to be on this webinar together. And so what I wanted to do today is explain and kind of pick up, Dave, where you left off about the smart beta movement. Obviously is one that is at the forefront of everybody's minds today, forefront of a lot of discussions, and frankly a lot of heated debates out there. And I want to talk a little bit about how we look at smart beta, how we use and use our point and figure methodology and charting system to actually develop a number of systematic discipline rules for indexes that are smart beta ETFs and ways to invest in a smart beta fashion, and talk about ultimately how to implement those two things into your portfolio. And so there's a lot of studies out there, a lot of academic works, a lot of white papers that have been written about the investment factor of momentum or relative strength, as we talk about it oftentimes. Those two words obviously used interchangeably, but this is just one study that was done, as Dave referenced, done by AQR Capital Markets a number of years ago that looked at this factor of momentum and the idea that things that do well, stocks that have gone up the most, tend to continue to do well over time, and that's the whole premise behind momentum, and it's the whole idea of kind of the law of physics. Things in motion tend to stay in motion, and that's what this particular study done. Moskowitz and Tobias Moskowitz study showed that stocks with the best momentum outperform stocks with the worst momentum, both in absolute terms as well as in relative terms. And that's kind of one of the papers that has been written out there, and that speaks to why we use momentum, why we look at relative strength as an investment factor. And it's not an investment factor that is new by any stretch of the imagination. It's a factor that has existed and persisted in the market for many, many years. And this is another research study, and this one done by RBC Capital Markets as well as a couple of years ago. And they utilized the Fama French database of momentum investing as well as value indexes and as well as growth indexes, and look to see if any one of those three or all of the three actually independently outperform just the S&P 500 over time. And interestingly, what the study found is that both value and momentum actually outperform over time on an annualized performance basis. Where if you look all the way back to the 1930s, the S&P 500 has seen an annualized performance return of about 9.4%, whereas growth over time, just pure growth indexes, tend to underperform with an annualized performance of 8.9%, but value outperforms the market 11.6%, and momentum outperforms all of them over time at 13.1%. And it's interesting, in addition to, while momentum outperforms over time, doesn't mean it outperforms all the time, and I'll talk a little bit about that, but over time certainly outperforms. When you look at just on a 3-year rolling basis, momentum is also one of those factors that tends to have one of the lowest failure rates. And as Dave mentioned earlier, we look at smart beta in general, momentum, relative strength investing. It's not a silver bullet, but it's designed to identify and designed to exploit an investment factor that is inherently present in the markets. And on the bottom right-hand side of this chart here was a study that was done that looked at just 3-year, 36-month rolling periods of when factors underperform the broad market. And it was looking at quality, it was looking at momentum, looking at small caps, looking at value. And what they found is that on a 3-year rolling basis, momentum had the lowest periods of underperformance, or the less lowest frequency of underperforming 3-year periods. So obviously does well over time. And the question is, how do we harness it? How do we look at relative strength and actually put it to use inside of a portfolio? And there's lots of different ways to calculate momentum out there. We hear all kinds of ways of looking at 1-month momentum, 3 months, and 6 and 9, and the way that we look at momentum is very, very different, and we look at momentum through the lens of the point and figure methodology. And if you're not familiar with point and figure methodology, it is very simply a form of technical analysis. And I'm not going to go into all of the details about the point and figure methodology and all of the nuances about it. It's a methodology that was developed back in the late 1800s, and Charles Dow being the first big proponent and developer of the methodology, whereas Charles Dow was a fundamentalist at heart. He had an appreciation for the fundamentals of a company, but at the end of the day, he wanted to marry that up with what was actually taking place in the price movement of that stock over time. And that's when he created a form of charting called figuring, where he looked at the price action of stocks over time. That, now known more popularly as point and figure methodology, is a point and figure chart consists of columns of X's and O's, very simply, where a column of X's represents that the price of a security is rising, and a column of O's simply suggests that the price of a security is falling. And those two columns will alternate over time. And one of the things that we do with relative strength and at Dorsey Wright is track all the stocks that trade in the U.S. as well as stocks all over the world. So if we look at stocks that trade here in the U.S. or Indonesia or Malaysia or China or the U.K., we can track a point and figure chart on those stocks. We can also look at the relative performance. And to where here's an example of what we would call a relative strength chart, of just using Starbucks as an example. And so every single night we take the price of Starbucks, we divide it by the S&P 500 equal weighted index, and we multiply that number by 100. That number that we multiply by 100, that number has no meaning to us until we ultimately take it and put it onto a point and figure chart. And so what we do, instead of plotting the price of Starbucks over time, we're plotting the relative performance of Starbucks over time, such that as this chart rises in X's, it suggests that Starbucks is outperforming the market. And as it begins to move lower in the column of O's, it's beginning to underperform the market. And I've identified trends in outperformance on this chart here. We're looking at a period on the chart that goes all the way back to 1994. So these are longer-term charts that we're looking at, long-term trends. Relative strength or momentum is not something that we view as a very short-term trading tool. We look at as a tool to identify long-term trends in outperformance, to the extent that if I look at Starbucks and I look at when Starbucks was on what we would call a relative strength buy signal, very simply, a relative strength buy signal is defined as a column of X's that exceeds the previous column of X's on the chart. And you can see that the dark highlights there in green. Well, in April of 1999, Starbucks moved to a relative strength buy signal on the relative strength chart and stayed on a buy signal until February of 2007. And over that time, both Starbucks and the market were up in absolute terms. However, Starbucks was up 323%, while the S&P equal weighted was up 87%. Something happened in February of 2007, and this chart moved to a relative strength buy signal. Something happened in February of 2000, and this chart moved to a relative strength sell signal. And what that suggested, the chart was suggesting, was that Starbucks was no longer worth the single stock risk. We were better simply spreading our chips across the table and moving off to the sidelines instead of being invested in Starbucks. And in February of 2007, this chart had a column of O's that exceeded the previous column of O's, giving a relative strength sell signal, suggesting that we no longer want to be invested in the stock. And in absolute terms, both the stock and the market were down. However, Starbucks was down 67%, while the S&P equal weighted was down 53%. March 2009 comes along. Something's going on with the price action of the stock. Literally a week after the market bottomed in March of 2009, something's going on out there in the market that the price of Starbucks is moving higher, or is outperforming, but moving higher at a faster rate than the market is. And nothing necessarily fundamentally has changed about the company, but something's going on out there in the market. Investors are out there casting their votes, bidding the price of the stock up, such that in March 16, 2009, the stock moved back to a relative strength buy signal, suggesting that it was once again worth the single stock risk. And since then, It's up 778%. The market, as defined by the S&P Equal Weight, is up 254%. Now, this is a very basic example of a point-and-figure relative strength chart and how we look at the market in a view of relative strength, and how we build smart beta indexes that exploit this momentum factor, whereas instead of taking a look at just one stock versus another, we take a look at a universe of stocks versus each other. And the way that we tend to think about this is think about this in terms of sports teams, and pick basketball as an example, college basketball. If we think about college basketball for a second, we have a defined inventory. There's a set number of college basketball teams that exist out there today. And throughout the season, all of these teams, they get together and they play a number of games. And as those games are played, there are defined outcomes. You either win a game or you lose a game. And by playing all of these games, by going through this grueling competition throughout a season, then the NCAA committee can rank these teams at the end of the regular season, can rank them in the NCAA March Madness tournament, such that the team that has the most number of wins gets the highest rank, and so on and so forth. And you could point to a great example of NCAA March Madness where there are upsets, right? Things happen along the way. Some of the lower seeded teams do win a game or two here and there. But if you look at the bulk of the NCAA tournament, the history going back to the 1980s, the winning percentage for the number one ranked teams is 80%, while the number 16 seeded teams have never won a game. And when we talk about relative strength and momentum, this is what we're talking about. We're talking about a ranking system, right? To the extent that our games or our teams are stocks instead of college basketball teams. The games that we play, instead of being on a court, we play them in the market. And we put those two things through a relative strength chart like we looked at Starbucks versus the market. Instead, we compare, let's say, Starbucks to Apple computers. And as we go through that ranking process, we simply tally up the total number of wins that any stock might have, and we rank those stocks in a very systematic and repeatable way. So within what we call our technical leaders indexes, we go through this exact same process here, to where once a quarter we rank an inventory of stocks of the largest, call it 1,000 stocks that exist out there in the marketplace. We rank those based on relative strength metrics. So the stock that has the most number of wins is given the number one rank. And then what we do is we don't look to buy all 1,000 of those stocks. We very systematically pick off the top 100 stocks, the stocks that have the highest relative strength, and we hold those stocks in an index for one quarter, dump everything out, go through that same evaluation again at the end of every quarter. And we do that not only in the U.S. market, but we've seen that phenomenon, that momentum factor works very well in the U.S. markets, but it also works very well in the small cap segment of U.S. international markets. We even have seen that the factor can be exploited in individual sectors, and the application goes deeper than just the large cap U.S. equity space. But within our core technical leaders index, that was the very first index that we launched in terms of a smart beta index that was replicated inside of an ETF that was launched back in 2007 and is replicated inside of the PowerShares DWA Momentum ETF, PDP, which is an ETF that trades that is based on that technical leaders index. So very systematically we've seen over time, again, not every single time, not every day, every week is going to outperform, but what we've seen is very systematically over time we've seen relative strength as this investment factor outperform just a broad-based index. Very interestingly, though, it is one factor. It is a premier factor in the marketplace, but it also does play well with other factors. It gets along well with other factors in the sandbox, and one of those factors that it does play very well with is a factor in volatility, especially low volatility, as well as value. And those two, value and low volatility, as factors tend to be pretty complementary factors to momentum investing. And the reason being, very simply, is that both value or low volatility and momentum tend to do very well over time in terms of outperforming and providing excess return above and beyond the S&P 500, but they tend to achieve those excess returns at very different times in the marketplace. And so they have very complementary characteristics when combined together inside of a portfolio. So I want to talk a little bit about that for a minute in terms of yes, momentum is a premier factor in the marketplace, but let's talk about how it might work well with other factors. And in particular, we'll use low volatility here as an example. And low volatility, I think everybody kind of understand what that means. It's looking at volatility very definitionally is a statistical measure of the magnitude of up and down asset price fluctuations over time. And very simply, what that means is having exposure to the equity market in the places that don't tend to have a large amount of fluctuation, right? That's what we think about when we talk about low volatility. And there's indexes out there that low volatility absolutely would be considered a smart beta index. And there's a number of indexes out there that allow you to access low volatility investing in not only large cap stock, but in small caps and mid caps and international markets through the PowerShares low volatility suite of ETFs. And very systematically, what they do, for instance, in their S&P 500 low volatility ETF, they go back and they look inside of there in a very systematic and rules way to get the lowest volatility stocks over the past 12 months. Very systematic, very disciplined, very rules-based. And if you look at, kind of the Morningstar graphic of its ownership, it tends to have a value to deep value tilt to it, to that portfolio. And so that's why that low volatility tends to work well in terms of complementary with momentum. And so what we did is, we kind of wanted to put some numbers to that. So in theory, these two things do work very well together, but what does that actually look like? And so we set up just a very simple study to take. Let's say we simply split a portfolio 50-50, and we own 50% in what we would call our technical leaders index, so 50% in momentum, and then the other 50% would be allocated towards low volatility. So very, very simple, 50-50. And if you have access to our website, you can actually pull this ticker symbol up and pull a point and figure chart up on it. And that symbol being PDP SPLV, if you put all those two together, you can get that on the Dorsey Wright system. You can look at that, and that's just a simple 50-50 split between momentum and low volatility, rebalanced at the end of every year to get back to a 50-50 portfolio. And what we have seen about this, if we combine that portfolio, you get a dividend yield that's about 1.3%. So it's, you're not getting as high a yield as you are in, say, the S&P 500, but you're getting a dividend yield. You have a basket, if you dump out the underlying holdings of those two indexes, you have a basket that owns about 190 U.S. large and mid-cap stocks. And at the end of the day, if you just look back over a 10-year period, you have an annualized performance on a 10-year basis of 7.71% for this PDP SPLV combination, so 50% momentum, 50% low vol, versus just the S&P 500 annualized performance of 5.8%. So you're talking about 200 percentage points of outperformance over the past, each year over the past 10 years based on this back test. So that's one thing, the performance over time, combining these two factors. While they both independently do well, you combine them together and you have results that could look like that, where performance is not only good, but then you also look at the standard deviation. So you look at what kind of volatility am I accepting or have I accepted to get those returns, just looking back over, using a simple 3-year standard deviation calculation, whereas you're getting performance numbers that are higher than the market, but you're getting volatility numbers that are lower than the market, 8.5 versus 8.95 for your combination versus the S&P 500. And so the reason that happens, again, is because momentum and low volatility factors are complementary strategies. They outperform over time, but they outperform at very different times. And I'll give you a case in point example from last year. Whereas if you looked at just last year, just 2014, and you looked at the PDP, you looked at momentum index, and then you looked at the low volatility index. There were only 2 months out of the last year to where both of those indexes were up in the same month. That's pretty interesting. Only 2 months were both those factors up in the same month, but at the end of the year, both had double-digit returns, and both outperformed the S&P 500. And so you got this very consistent stream of excess return over the S&P 500 coming at it from 2 different angles, getting you to a place at the end of the day that provides this very generally good experience from an investor standpoint with excess return with lower volatility over time. So, when we talk about complementary strategies, this is, what we see, and you could, low volatility is a great complement to momentum, and as I mentioned earlier, value, deep value tends to be a very good complement to momentum, and you saw low volatility tends to have a pretty good bias towards that momentum, or excuse me, towards that value side there as well. So, you can look to, and while we come at it from a 2 very different lenses, you look at 2 indexes that generally don't have a ton of overlap. So you're getting, sector weights, for instance, inside of low volatility that has a pretty good overweighting towards, let's say, financials, and this was as of the end of March of this year, but pretty good overweight towards financials, whereas technical leaders, whereas a momentum index has been relatively underweight financials. But on the other hand, you look at a sector like consumer cyclicals, that is more than a third, accounted for more than a third of the momentum index, whereas it only accounted for about 5% of the low volatility index. So you can get, these two portfolios can look very different over time, but when combined together, again, they tend to work very well over time. So, that's, one of the things that we do, and then we really look at it is smart beta as a trend is certainly, I think here to stay. And there's, every day there's more and more ways to access different segments and different slices of the smart beta investment spectrum. And what we like to do is talk about, how do we take these and make them usable inside of a portfolio? How do we ultimately help build portfolios that replicate what we want to get exposure to in the marketplace? And this is one very simple way is combining momentum, combining low volatility within a core equity holding in the portfolio. So the last thing that I did want to talk a little bit about, and without getting into a ton of grave detail with this here, is talk about adding another layer to this idea of combining momentum and combining low volatility. Is that one thing that we know is that momentum indexes do well over time, like I said, but they also tend to do better in strong equity markets, right? So they tend to do better, for instance, when trends are strong, trends are established, trends are not switching every other day or week. Whereas if I had to put go back and pick a time period in history to say what type of market does momentum struggle? Well, momentum struggles when when equities as an asset class are out of favor, and even to the extent of a year like 2011 where you get a trendless market. You don't get a lot of trends that persist. You get a lot of volatility and not a whole lot of trends that persist within the marketplace. So those are 2 kind of environments, and one way to combat that a little bit is to add a layer of asset class evaluation to your portfolio construction. And so this is a very simple study that we did here, and one of the things that we do at Dorsey Wright is we, in addition to ranking stocks, we can rank sectors on a relative strength basis, but we can also rank asset classes. And those of you that are familiar with our research and familiar with the site, one of the tools that we have is what we call our DALI, our Dynamic Asset Level Investing tool. And that tool is very simply for us a means of ranking asset classes. And we look at the world in 6 broad asset classes, those being U.S. equities, international equities, fixed income, cash, currency, and commodities. And those 6 asset classes are what we look at. So every single day I can log into the website and I can see out of those 6 asset classes which one is ranked number 1 and which one is ranked number 6 and everything in between. So if I know that momentum tends to do better in strong markets and when U.S. equities are favored, essentially. So when U.S. equities are in one of the top 2 spots in Dolly, what I want to do is I want to overweight the momentum factor. However, when U.S. equities moves out of favor, so if U.S. equities as an asset class drops out of the top 2 of our asset class rankings, then I want to get out of momentum, or at least underweight momentum in some capacity, and I want to overweight a factor that does well when the U.S. equity markets are out of favor, and that factor would be low volatility, tends to do much better during those types of environments. And so this was a study that we did that goes back into the late 90s that just looked at the green line down there on the bottom, just looks at buying and holding the low volatility index through thick and thin, not making any changes, 100% invested in that index. Tends to have produce a relatively consistent and steady stream of gradual returns. The next one up, the blue line, is representative of just simply buying and holding the high momentum index, or the technical leaders index. We simply buy and hold through thick and thin, good markets, bad markets. We buy and hold that index over time. The third line, though, is the red line that you see there. And that red line is what we call the RS switching, or relative strength switching strategy, such that when U.S. equities are ranked within the top 2 asset classes in our Dolly ranks, then we're going to own the high momentum, we're going to own the technical leaders index. However, in periods in which U.S. equities move out of favor, then we're going to sell that momentum index and we want to buy the low volatility index. And so those are the periods that are shaded with the blue background. During those shaded blue background periods, those are periods where our research suggested that U.S. equities were out of favor, and that was defined by U.S. equities being ranked out of the top 2 asset classes in Dolly. And so what we found is that by overweighting momentum stocks when U.S. equities were favored, and underweighting momentum stocks when U.S. equities were out of favor, produced far superior returns to either of the investment factors independently over time. And to the extent that growth, hypothetical growth there of $10,000 in the RS switching grew on this chart up to about $120,000 versus a growth of up to $80,000 for high relative strength and up to about $30,000 for the low volatility index. So this is just, for another food for thought there for you, and then, kind of how we look at this world of smart beta and how we ultimately look at using these different smart beta vehicles, not only in terms of constructing the index, but also utilizing them in terms of a portfolio manager construction way by overlaying asset class analysis on top of these 2 different investment factors that are very good complements over time. So with that, I want to stop there for a minute and I know turn it back over and see if there might be any questions out there that exist for anybody about anything that we've discussed today.
Thanks, Jay. We actually do have questions from the audience, so I'll roll them out here. First one we have is, does Dorsey Wright's approach in using relative strength as opposed to traditional time-dependent momentum, 13 to 1 months, make your approach more susceptible to short-term momentum reversals? And how do you guard against that?
Sure, that's a great question. And what we know is that there are certain time periods, for instance, short-term momentum, call it 1 month momentum, it does not tend to have any real predictive value to it. By looking at very short periods of time, there's really no predictive value in it. And if you go at the other end of the spectrum and you look at a 3-year momentum, there's really not much predictive value in that either. There is a sweet spot, and we know that sweet spot over time tends to be somewhere between, say, a 3 to 12-month time period. The difference there is there are different markets reward shorter-term momentum more so than longer-term momentum. And in other markets, reward that longer-term kind of look-back period than they do the shorter-term look-back period. And so with the way that we look at relative strength through the lens of the point-and-figure methodology, we essentially, instead of trying to tell the market that we're in a market that's rewarding 12-month momentum more so than it's rewarding 3-month momentum, for instance. We let the market tell us, and the market tells us through how the charts react over time, such that if volatility is a little bit higher and the charts are reacting to that volatility, they're going to change quicker, and it's suggesting to us that the market is wanting to favor that shorter-term momentum, whereas if we're seeing very slow developments take place within the relative strength charts and how those charts develop, what it tends to suggest to us is that this type of a market, whatever that might be, looking at is rewarding the longer-term momentum. And I'll go back for just a second, if we can, and I'll look at this slide as in the case of Starbucks as just a very quick example. And what we can look at on the case of Starbucks, and if you can see it, the case of Starbucks going back into the October 2006, February 2000 time period, what we saw during that time period is the chart peaked in a column of X's in October and ultimately gave a sell signal in February. And if I look at that, what that suggested to me is that the market was favoring, a momentum factor that was on the order of, closer to 4 to 5 months versus waiting a full 12 months to see those investment factors perform. So absolutely, I mean, different markets do reward shorter-term momentums versus longer-term momentums, and I think the approach that utilizing the point-and-figure methodology actually helps in identifying which markets we're in.
Thanks, Jay. Momentum is typically high turnover and high capital gains. Is there a benefit of using ETFs instead of mutual funds for momentum strategies? For example, if you were to compare the after-tax returns of Dorsey Wright Associates ETFs versus AQR mutual funds?
Well, so sure. I mean, I would say the benefit would lend itself far better to the ETF structure and the ETF chassis, just how the structure is built. Because of the in-kind exchange of the underlying securities, the ETFs are tremendously tax efficient in that capacity, whereas we could look at, say, a technical leaders index that could turn over, let's call it 100, 150% on any given year, where that type of process that takes place because it's a quarterly evaluation, I mean, we could, at any given quarter, we can see a 30% turnover just in one quarter. And so that's, where I'm getting to that, between 100 and 150% turnover per year, which is a very high turnover to run this type of process inside of a mutual fund wrapper versus an ETF wrapper that is much more tax efficient in that capacity. So yeah, I mean, the ETF structure is far more efficient way to access these momentum indexes than the traditional fund wrapper.
Thanks. Excuse me. As more investors learn and start using momentum investing, does this factor lose its impact over time as more money goes to it?
Yeah, no, that's a great question. And it's certainly something. One thing that we know about momentum is it's not a new phenomenon, right? Despite the phenomenon that momentum investing over the past, I'll really call it year or two, maybe a couple of years, you go back longer, it's become more popular, it's become more accessible through ETFs. We saw the Technical Leaders Index launch back in 2007, so we've seen that out now for a number of years, but more in the past couple of years, you've seen the popularity grow. And what we know is that this is not a new factor, right? It's persisted for many, many, many years, and we looked at some studies that go all the way back into the 1930s that suggest that this investment factor has persisted for years over time. So I would argue that no, the more people that see it and view it don't necessarily make it any less reliable or less attractive. I would venture to say that if you look at any of the most popular investment strategies out there, the vast majority of the most popular strategies tend to be some of those things that tend to be very simple and very straightforward in value, right? The one of the most popular strategies out there over time is value investing, and I think you could make the argument that far more people and the crowds look at value investing or investing based on value stocks far more than any other investment factor out there. Yet has that lost any of its predictive capabilities or any of its excess return? And I would venture to say no, even on that one, because we looked even on the value factor that over time tends to do well. So I would argue that no is that it doesn't lose any kind of luster over time.
Why not go to cash or 3-month treasuries versus low vol?
Yeah, so it's a good question. I mean, you certainly you certainly could. I mean, there's ways that you could look at. You could use relative strength even to make that determination. Do you even want to be invested or not? The way when we look at low vol and kind of looking at the study here is we're looking at basically what we're saying is we want to provide equity exposure through the use of 2 investment factors that adds value above and beyond just simply buying and holding the market. It does so in a little bit more less volatile way. But you could certainly absolutely run analysis to look and say, do I even want to be in stocks or not? And that's when we talked about kind of the dynamic asset level investing tool, our Dolly tool, is we treat cash as its own asset class. And so if cash works its way up the ranks within relative strength, then you have to ask the question is, one, do I want to own stocks, and even how much stocks do I want to own? So you certainly could answer that question. When we're talking about kind of providing the core equity piece, that's when we're looking at combining these 2 factors to get at that equity exposure.
Why do you think the S&P 500 has been a better universe to generate outperformance via equal weighting?
Yep. So I think one of the biggest reasons on that is just the sheer headcount perspective. So you're adjusting the weight more dramatically across a more diverse name set when you have 500 names, or if you had 1,000 names versus when you have just 100 names. And so it's one of those aspects of size as a factor, much like momentum or volatility or other factors from a performance perspective, that benchmark universe of which it's applied against does tend to be very important. It would be very similar to that on a volatility side. So the S&P 500 just having more names, you end up having more opportunity to find and track down those low vol names or those names with high momentum than you would off of an index like the NASDAQ 100. The other aspect on that is just the NASDAQ 100 itself has performed so remarkably well because of a lot of its top-heavy names. The top 10, 15, 20 names out of the index have also performed very well versus the 500, which tends to get far more mid-small cap market capitalizations than the 100. So the average market cap within the 500 is smaller. The smallest component is smaller than that of the 100. So all those factors, all those elements contribute to the size factor, which is essentially what equal weighting is. And so you can see the 500 equal weight then have a better relative performance to its benchmark than the NASDAQ 100 equal weight.
Great, thanks. Final question. Excuse me. Low vol and momentum are polar opposites in basic strategy. Is that what makes them so powerful together? It seems counterintuitive.
Yeah, I would argue that yes, it's because they are very much polar opposite factors. That's why they do work so well together. It's because they're 2 very identifiable factors that produce outperformance over time. But again, they do so at just very different time periods in the market. So when momentum is doing very well, then low volatility things tend to underperform a little bit. So while the market is accepting the higher momentum names, they are shunning to some extent the lower volatility names, and vice versa. And so that's why, reference last year, for instance, in 2014, where momentum and volatility, both two indexes that managed to outperform the S&P 500 in over that year, but there was only 2 months that both of those indexes were actually up in the same month. And so, yes, they are actually absolutely two polar opposites, and that's, why they work together. Opposites attract.
Great. Thank you, Jay. Thank you, Dave. Excellent presentation, very clear. I'd also like to point out to our audience, if you need more information on smart beta, we have established here at ETF.com a smart beta channel that has lots of material in it, including a smart beta guide, as well as some research papers, news, and some other tools to help you navigate the smart beta ETF landscape. And with that, I'd like to thank you for joining us. A reminder, tomorrow and Friday we will have another smart beta webinar on smart beta, and that starts at 2 o'clock Eastern Time, 11 o'clock West Coast time, and that's Thursday and Friday. Thank you very much.